I've worked roughly 10 years in the Middle East with a bank, and I found that very few people stick to one company, and the clients keep opening their accounts in the several bank. I wanted to be true to the client. The whole issue in this part of the world is people keep representing company, they keep representing the product, but do they represent the client? And I think that is the most important and salient feature of our company called Client First, where we are here because of the client, we are here for the client, and we are here for serving them forever. So I think Client First is true to the name of the group. We do not represent anyone else. For us, the client is the everything, and we are so transparent. We earn everything from them. So we don't bring companies to the client. We take clients to the companies where they feel that it is good for them to deal with. That is why the name Client First. So Client First Capital today is a Mauritius regulated entity. It is a portfolio advisory and investment manager. It is investing on behalf of the client in the global equity and making them money by investing into the best of the business in the world. And the most unique point about the Client First is it is a very transparent organization, and we work on a performance fee basis. That makes us very unique. We also strictly practice Warren Buffett value investing principle. So more or less, Client First Capital is a family office which invests their own money, and they also invest clients' money where they invest their own money. So basically, we are the halwai who eats their own sweets. Or in English, you can say we eat our own cookie. And that's what the Client First Capital is. So how Client First Capital work is a very simple method that we do a bottom-up approach of finding the best company in the world. There are three types of company: great, good, and gruesome. We look for great companies. We have shortlisted out of the universe of roughly 10 to 15,000 stocks, roughly 40 to 50 companies run by the best families in the world. And from there, based on the several criterias and several checklists, we keep on rejecting and rejecting and rejecting. And then we have these 40 companies. And out of the 40 companies, based on the valuation, the quality, and the growth, we invest at a time 10 to 12 companies. So we are basically a concentrated investor, or you can say concentrated equity investor. The clients open their account with us either in the fund, or they open the account with the world's second largest broker. We are the institutional client to the broker, and as per the US law, the broker works on the behalf of the client and helps the portfolio advisor to invest that money and grow their money. Client First Capital started in the first half of 2015, and the journey is my wife and I both co-founded the company, and with only intention to be true to the client. We started onboarding clients. I remember in 2021 we were only $6 million, and then today we are $50 million at the AUM has grown at a rate of 50% CAGR. The revenue has grown at the 50% CAGR. And we have maintained 19% CAGR for any investor who came on the day one, which is roughly 2.2, 2.3 times of the money we have made. The journey has been very good. Except the 2022, every year has been profitable. The maximum time has spent on research, and research, finding the great companies in the world, talking to employees and ex-employees and the management, and reading the balance sheets and financials, and reading so many books. Every time has been spent on finding the great company on behalf of the investors so that they make money, so that we make money. The whole idea is that the people make good money, at the same time the risk is lesser. Now, the journey has been fantastic because there has been a huge learning with the earning as well. That learning is such a great thing that now I've become a bookworm, and I think I can smell balance sheet, though I still feel that I have a lot to do. And it has also crafted me in a manner that I have understood that what should I give to the world so that the world is saved. So today we make sure that we take care of the investors rather than they decide what they would like to have it. I strongly urge everybody to learn the power of compounding and how simple the life is. We have also a concept called KISS, keep it sweet and simple, because I think the world does not need the exotic product. The world is busy in selling the exotic product like derivatives, the forex, the structure notes, and I don't think so world needs it. And the one more very hazard word in the investment industry is leverage. I think you can take operating leverage in the business, but you should not or never take financial leverage. A good quote for the leverage is, leverage does not add any value to the investment. It magnifies both the side. It magnifies the losses, it magnifies the gain. But one should not forget that investing is a survival business. And all you have to do is survive the bad period. Warren Buffett, Berkshire Hathaway, 3 times in the last 50 years have gone through a 50% crash from the peak. And if one is leveraged, he will be vanished. All the great companies in the world, the one thing which have made them perish is debt, debt, and debt. And I always ask this question to my investors, that the reason you have survived, the reason I have survived in the business is because we don't have debt. And if you don't have debt in your life, in your business life, why should you have debt on your portfolio? So by keeping it sweet and simple, we are telling the world that we can beat all the exotic products, because somewhere these exotic products are not for us, because that they don't explain the construct. So absolutely Warren Buffett has shunned derivatives, and all the world should shun derivatives, future options. They're not needed. We should never short the stock. Now, why should we never short the stock? Because when you buy a company, a stock, a good company you buy, and you buy it for $10, the upside is huge. The downside is only $10. What can you lose? $10. But when you let it run, it can become 1,000 times. But if you short a company, you can maximum make $10, and your downside is huge. So asymmetric payoff is something what I love, what Warren Buffett also loves. So when you buy a company and you let it run like a bullet train, you have an asymmetric payoff. So that is why I strongly feel that the exotic products are not needed. And this is the journey of Client First Capital, that we have been keep telling our investors to keep it sweet and simple. And we allow these companies to run. And that is why we would like to be permanent owner of this company. That's what the founder's portfolio is. The core values of Client First Capital are transparency, ethics, and simplicity. Why transparency? You may cheat somebody for a month or two, but in the long run, the competitor will go and tell him or her what exactly you have been doing. It is great to have the discussion in advance about what you're going to gain in the relationship and what they're going to gain in the relationship. A very simple thing I tell all my investors, that if in this relationship you make money and I don't, the relationship will not survive. If I make money, you don't make money, you will leave me. If we both don't make money, the relationship will not exist. But if you make money and I make money as a company, and we both work as a partnership, and that is why a lot of senior staff in a company are on incentive. A lot of great companies are built because they give a lot of incentive to their employees. That is why a chief executive officer has a percentage of profits as his KRA. So the most important thing I feel is the transparency. Now the transparency is you tell your benefits, you tell their benefits, and they're all laid down, and then you work on that transparency parameter. The second is ethics. Now, after being transparent, you need to practice and follow those transparency with ethics. The ethics are such an important conduct, like speaking the truth. Because if you do not know what you are going to speak tomorrow, and that is why they say people cook lies, but the truth is straight. Once you speak the truth, you can sleep peacefully in the night. But if you cook the lies, you absolutely don't know who have you told what. That's our second core principle. And the third is keep it sweet and simple. This is a very important thing. I'm not having an IQ of 120, or I don't have an IQ of Elon Musk. I strongly feel that I have a good EQ, and Warren's way is so dear to me because it does not want me to be a Harvard or Stanford graduate, but it tells me to become better emotionally every day, and that is why I think the stock market is a humbling game. It's a game of patience. It's a game of temperament. If you read about the great investors, they all have talked about the great temperament. I remember various time I have sold a company, but if I would have kept it, I would have made more money for my investors. So the third very important principle is to keep it sweet and simple, which is basically have a good EQ and have a good patience. So client first vision is to grow and list them in the stock market in the next 8 to 10 years. That's also the not a long term vision, it's a mid term vision. The long term vision of the client first capital is to transform in a holding company and buy the bits and pieces of great companies and keep making money for the investors. And this money should also be used for the charity purpose. I still recall Rakesh Jhunjhunwala was a great investor who is not there anymore with us. But our Jhunjhunwala Foundation is doing a fantastic job in the field of charity. So the only purpose to make wealth should be to give it back to society. And the long-term vision is to donate the money which we earn from the client first capital. The mid-term vision is to get it listed, make it larger so that the world understand that we are here not to be good, but be good to win. And that's the long-term vision. That's a pretty good question. So when I was transitioning from an insurance broker to an advisor, I happened to attend one of the seminar in Delhi, and there I learned about something called power of compounding. And then I got introduced to the India's one of the premier institution in the equity called Motilal Oswal. And Motilal Oswal, I used to think that it's a name of a person who's not there. But I'm very happy to met Motilal Oswal in person. Motilal Oswal has a partner called Mr. Ramdev Agrawal. They both are the family and they own roughly 70% of the business. So Ramdev Agrawal and I belong to same place. And that made me strike that, wow, I have an honest person from my place and he's a billionaire. Why don't I study him and I read about him? So I soon after, there is a saying that if you wish for something so intensely, you will get it. I happened to meet Ramdev Agrawal because of my association with Motilal Oswal, and I had also listened to him his various of his videos. And when I met him in person, not once, not twice, in fact 4 to 5 times, I realized that billionaires are so simple. Now, after meeting Ramdev Agrawal, I met several other people through the Motilal Oswal who were the fund managers. I read a lot of books, and every book talked about the one and only Warren Buffett, who is also called the Oracle of Omaha, and also now he's called the father of value investing. Now, every year in Omaha, he does his Berkshire Hathaway event, which is his holding company. So I was compelled to know more about him because of the books. I was compelled to know more about him because of the people I've looked up to. They looked up to him, and that's why the only person which I think it is good to have. I'm sure none of us would like to have a middleman in the between. So that is why I booked my ticket and visited him and on Omaha. And that is why Warren Buffett is one guiding principle. The other reason is he's very open. Now, there could be other billionaires, but Warren Buffett is very open about his method. One can easily look at his shareholder letters. He can go to the website and read them. It's a word of wisdom. So that is why Warren Buffett, because first he has a longer journey of roughly 60 to 70 years of investing journey. At the same time, his methods are replicable and they are open. And that is why Warren Buffett. So Warren Buffett, a lot of people think that Warren Buffett is just a stock market expert. No, that's not true. He's a very good quote from Warren Buffett. I'm a good businessman because I'm an investor, and I'm a good investor because I'm a businessman. So he is telling the whole world that businessmen and investors are not two different people; they are same person. So Warren Buffett, he in the starting journey was a broker. After that, he became he opened a Berkshire for Warren Buffett partnership, which exactly what the client first capital does in the current format. And he had the limited partners in them, and these people used to invest with him, and he used to invest in the market on his behalf. For roughly 13 years, Warren Buffett invested on behalf of their limited partners, and he made them money. And then he dissolved the company, and he took a he from his money he took a share in a company called Berkshire Hathaway. It was a textile company, and later on he converted that into an insurance company. So in that company, he keeps on buying the jewel like Seas Candy. You can see their shops across the Middle East. He also bought a company called Brooks, which is famous for running shoes. He bought a railway line. He had a company called, which is also in the ice cream business. And like that, he kept on buying the companies which were available for private. There's a very good company he bought from a lady who was, I think, she died at the age of 105, Nebraska Furniture. So like that, he had a lot of jewels which are unlisted. At the same time, he also has a lot of money from the insurance float. With that, he also buys a lot of public listed company. Like he had share in Apple. We all know about it. He also still has share in Amazon. So at the end of the day, in a one word, he's a capital allocator. And the second way, he's also a great example of leading a life so simple. He still drives his own old Cadillac. He still eats McD burger and have Coke. So he, in my opinion, from the business point of view, is a great businessman. From the investing point of view, he's a great investor. And from the point of view of being honest and ethical, and one should understand the corporate governance from him. Books have been written on him. Now, like I always say that people who write the book, they are great people. But people on whom the books are written are the greatest people. So in my opinion, Warren Buffett is guiding pretty well in on everything. He's a good father. He's a good husband. He's also somebody who has donated his money, has already announced for charity. And he's also a friend to a lot of people. And he's also telling us how to lead good life because his calendar is generally empty. So that's what Warren Buffett is for me. So Warren Buffett, I think I've already answered that. How Warren Buffett does it, he keeps things simple. He keeps it very honestly. And I think money is not his purpose. His purpose is value. So very early in his life, he understood a very basic principle that money can be made from a small city. We all come to the tier 1 city thinking that the tier 2, tier 3 cities or the small cities cannot help us to grow. But when Warren Buffett was told by his father to move away from Omaha, I'm sure we have heard about Omaha. Omaha is a town in Nebraska state of America. It is 6 hours from Chicago, where he still resides, and it is famous for Warren Buffett because still very few international flights come to Omaha. So this is the city where Omaha has become famous because of him. He made money being in that city. So how does he do it? First thing, he's very clear that he is chasing values. The second thing he's teaching us that he is away from the Wall Street. So to make money, we do not have to come to the big city. So if we are doing the right thing, people will come to us. There's a very good book called Build to Last. You build such a great institution or you do such a great job that even the biggest of the biggest people, or in terms of business, the shareholders flock in and they invest a lot in your business. So what exactly Warren Buffett, how he does it is basically he did not chase the money, he chased the value, honesty, ethics, and transparency. And that's how he did it. He is not a conventional person, but he's a very conservative person. A lot of people have this thinking that equity investing is a risky proposition. I'm sorry to say that equity is a very, very conservative business. and not a conventional business. So there is a big difference about it. And Warren Buffett being very conservative, I think he's done it. The first rule, the first principle, never lose money. And the second principle is don't forget the first rule. Now, what does that mean? A lot of people don't understand. One understanding is don't buy products which are not going to beat inflation. Because the biggest risk, in my opinion, is not to grow your money. And that is why the piggyback concept is a flawed concept. Because if you save $100 in 2 to 3 years as a child, and when you break your piggy bank after 10 years, how much will we get? We will not get back $100. In terms of the currency, we may get back $100. But in terms of the purchasing power, and that's what the value of currency, that money will not be able to buy what it could buy 10 years ago. So this is the one aspect of the rule, that don't lose money. The second rule, or second aspect of the rule, is when we invest without knowing what we're doing. There's a very good quote from him, is risk comes from not knowing what we do. They go together. The second thing is, okay, let me buy the meme coin, or let me buy something which I don't understand. And if money is made, it's made. No, the quote says that the investment returns are the risk adjusted, which means the lower the risk, higher the return. And that's what these two quote, the one quote is very close to my heart. So when we started our journey roughly 10 years ago in 2015, we had three businesses: the finance, insurance, and the fund management and advisory. Now, what exactly happened in the finance business? You will have a lot of work, but all the files which will come to you would have gone to everybody else. And you might be thinking that you have a lot of work, but very few cases will have their merit. And one more problem is that the clients need money. They don't really think whether you are going to give them service. All they are looking for to make money, or to get money for their businesses. And that is the only thing, that is the only relationship they have, or in a simple manner, they had a transactional relationship with us. So the moat is not built. There is no stickiness in the business. The second business is the insurance business, which is a very beautiful business. I also went to US and I've been also in MDRT. So insurance is a great business because it protects the client, it protects their assets. The only challenge in the insurance business is the gestation period is very long. And when you have a good client after 12 months to 24 months, when he's agreed to invest or take insurance with you, generally in the market, people give discount, which is very good for the client. But people don't think that they have to serve the clients for the at least 30 to 40 years, the lifespan of the insurance. And again, the problem is the market was crowded with so many insurance agents. So we thought, let's move to the advisory business. And then we moved to the advisory business and we tried to take the best product from the world to give it to our clients. Now, what we absolutely learned there in the journey, that if the product is very good, what happens is client make the money, which is very good for the client. But as a middleman, we don't make the money. Now, if I have a bad product or a product which charges more commission or upfront commission, the client will not make money. We might make the money, but in the long run, we will lose the client. The only savior for us is to become a fund manager, a manufacturer on our own. And that's how we launched the Client First Capital, which is a fund manager, an investor, and there is no middleman between us and the client. That is why we chose fund management. It's a sticky business. It is not that a client looks for a 15, 20 or 30% return. Clients are happy even at 8% or 10% or 15%. I know my peers who manage $500 million at 7 to 8%. It's not about the returns. It's about the trust. It's about the stickiness. It's about that they know your face. They know that you will never lose their money. And this is why the business is a very unique proposition, and clients' relationship will go for at least 3 to 4 decades. That is the reason we chose fund management. So founders portfolio is like the pearls bedded in a string. They are beautiful companies which are at least 10 to 20 years old with $1 billion market cap to roughly $1 trillion market cap, run by the passionate entrepreneurs who themselves are the long-term investors, and they are growth hungry. At the same time, they don't compromise on the quality of the balance sheet and the financial. They're the honest management. Now, Founders Portfolio is 10 to 12 companies together in this particular portfolio, which where the client, where they keep on investing and they keep on growing their businesses, they keep on expanding their business from one region to the other region. They're expanding online, they're expanding through franchisees, and thus they increase their net worth, and in turn that net worth transform in the share prices, and that's how clients make money. So founders portfolio is a portfolio of concentrated stocks of 10 to 12 companies run by founders, managed by people like me who are also a founder, and it's a complete transparent product where the client mainly pays the investors, the fund manager like us, when they make money. So a client opens account with the second largest broker in the world. We help them to do the paperwork. The fees are very transparent, and once the account is open, the client get the access to the viewing right, and where we get the management right. And on behalf of the client, we manage their money, and then every year there is a performance fee based on the performance we have given, and that is how it works. So it's a very simple fundamental. It works on the power of compounding, which is rule of 72. It works on power of quality, where we talk about return on capital employed of at least a good company will have roughly 20-25% of return on capital employed. In a long run, we look at the consistency of it. So if a company who has a ROIC or ROCE of roughly 15 to 20% for 5 to 10 years, that's a good quality company. The second criteria is the growth. There's a very good saying that all the money is made because of growth. So any businessman or any family owned business or a promoter who is a growth hungry, and if he can grow his business from 15 to 20%, and if it can be predicted by the quality, which is the ROCE, and if you bought them at the right valuation, which could be, let's say, between a P of between 15 to 20, this is the kind of company Founders Portfolio has. And these companies are bought on behalf of the client, and they are led to run and multiply not 2 times or 3 times, but 10 times and 20 times. And that's how Founders Portfolio work. My learning from the past is whenever the mistakes have happened, so there are 2 parts of the brain system, system 1 and system 2. System 1 is always trying to answer each and every question, whether right or wrong. And system 2 is a cautious, but at the same time, it's a lazy machine. So system 1 and system 2 coordination can only happen once somebody will have a checklist. A very beautiful book written by Atul Gawande on checklist is a manifesto of a surgeon. Because a surgeon, if he leaves a Caesars after the operation, even once if he does it, he will not survive. His license will be revoked. So a checklist is very important in everything. So my message to the world is whenever we perform anything, we should have the process document. We should have the checklist, because checklist will not let us commit a mistake. We all think we know more than what we know. And I'll give you a very simple example. Whenever I work on a project, I know it will not happen that timeline. Whenever I spend money for a particular project, I know I have to pay more money. So that is why a checklist and is very important. At the same time, it is also important to have extra cushion for the deadline for any activity. And that is what my message to the world. My best pick is a company which is chartering shipping vessel, which is not part of the portfolio now. I remember I was learning about this company in the COVID period. The COVID was just getting over. We were in something around September and October 2020. And one good line from Peter Lynch, where he said that if you buy a company at price to earning of 2 or 3, there is a very rare chance that you will go wrong. And when I pick these companies and my portfolio, I'm very clear that I'm not trying to make 10 times, which is part of the journey, but my main criteria is I should not lose the money. So I strongly believe that head, I make a lot of money, and tail, I make some money. This company called Denos Shipping, I bought at roughly a valuation, a price of $8. And within a few days and few months, what happened is this China and US has this big issue of the containers. The containers were all going to the US, but China was absolutely shunned. So they were all empty containers and nobody was there to take them back to China. And because of that, the freight charges and the shipping vessel charter prices have gone to the roof. And because of that, the stock in no time of roughly 6 to 7 months just climbed from $8 to roughly $101. And that was my euphoria moment where I made roughly 8 to 9 times on a stock which had delivered 40 to 50% return on the portfolio. That was one of the best pick. Coming to the worst pick, I think I have many, but one which is very dear to me, and I remember that as my learning journey. One is that I invested in China. Now, I'm sure China is a great market after the US, and everybody gets tempted to invest in China. And who has not committed a mistake in China? The biggest challenge, what I did not understand, and which I realized only from my mistake, is that China is an opaque market. China has a very low transparency. The information is not easy, and they have a lot of convoluted what do you call the setup for them to allowing the people from outside. And I'm very happy for China in a manner that they have their own Google, they have their own Uber, like a company called Didi. They have their own payment network, like Alipay. So they have made a lot of in-house great tech companies. But in the meantime, if you invest in those companies in China, or you invest in those Chinese companies which are listed in the America, the challenge is overall the China is a communist economy. Now, in the communist economy, it's all about the people. Now we all know how Credit Suisse has fiasco has happened. Now, obviously, China is doing great for their people, but it is probably not good for the capitalism in the short run. And that is why, if you look at China, very few companies have done wonders in the last 10 to 20 years. So one of my mistakes is to invest in China. And how I learned about it is when I consulted my seniors and they told me about something called variable interest entity, where when I invest in a Chinese company in few sectors, I'm not owning the Chinese company. I'm owning a BVI company which does not own the Chinese company. It has an options to it writes option to own the Chinese company. And then it also says that it is very difficult for us in the future to exercise those options because of the legal challenges. So in a manner, I am in a limbo as an investor. And I think the biggest mistake is to invest in China. I also learned about from the Mr. Scholes, who is the Warren Buffett's early days investor friend. He invested in Cuba those days, and Cuba became communist. So a very good learning has come to me from my worst pick, which is Geely Holding. It's a good company, but at the same time in the bad market. So that's my worst pick. Oh, there are many. So Peter Lynch is one to start with. As the journey goes on, Philip Fisher became my mentor. Warren Buffett will always be my mentor. These three people are my main mentor. I think the podcast will be small to tell all the mentors' name. These three people are my main guru. Oh, there are many. But one of the favorite book, which is not from the investing, is Bhagavad Gita. Now, Bhagavad Gita is so dear to me because it helps me to know who I am. Unless I know myself, how can I help the world to make money or to run a good business or manage my people? So, the most important thing here is to understand the psychology of man. We have taken so many birth, and after that, we become human. Have we become human to just eat, sleep, and pray? No. We have become to evolve. And the evolution will only happen when we will read our manual. Now, people read manual of sophisticated gadget like mobile, the camera which is here right now. If somebody will not read the manual properly, how will he become an expert? So you read the manual and then you practice several times and then you run. You become a cameraman or you know how to run a camera. Similarly, the most sophisticated gadget is a human brain and mind. And if we have not read the manual of it, how are we gonna survive in the world? So Bhagavad Gita is very very close to me, and it is manual of myself. And I think one has to go through Bhagavad Gita various times so that the Bhagavad Gita goes through me, and that is how you become a man of steadfast in wisdom. That's my favorite book. Three book to start investing to be read by everybody are The Intelligent Investor, wrote by Ben Graham, who's the father of value investing and the professor of Warren Buffett. The second book, which everybody should read about the behavior, is The Almanac of Charlie Munger, or it is also called Poor Charlie's Almanac. And third book, which everybody should read, is One Upon Wall Street by Peter Lynch. So Peter Lynch is also my investing mentor. In fact, this is my first investing mentor. These three books should be read by everybody. So it's a very the reason I teach in the masterclass. First of all, I visited Dr. Sanjay Bakshi. He teaches in he was used to teach in the MDI Gurgaon, and then he is now teaching in Flame in Ashoka University. When I was studying under him in Flame, I realized that a lot of these principles are very important to live a good life. Now, I don't think so anybody can teach anyone. I am a student for life. I teach to learn because we all are egoistic and we need to have one concept repeated once after again and again and again. So the reason I teach is because first of all, I become the better. I become better. The second reason I am teaching is because the world should not lose money. Now, every now and then I hear this story that people have lost millions because of somebody conned them. I'm sure everybody has gone through that grill. I don't want to hear those stories. I want to make sure that before even my people who are related to me or connected to me, they get from me a lot of information and knowledge. So probably they will learn from my mistakes. So the reason I teach is to save the world from wrong investment and wrong investors. So masterclass is right now divided into two subjects. One is value investing and the second is behavior finance. Now, what is value investing? Value investing is buying the assets below their intrinsic value. What is intrinsic value? Intrinsic value is when you pay something, the price for an asset when everybody is not ready to buy them. Now, how it's a very simple example. So let's say you buy a property. Properties are generally considered safe and they are close. They give you close to about a 5 to 6% return because the fixed deposit rates are generally 4% in the developed world. Now, if you buy a property, it's giving you 8 to 9% return as a rental return, which means you're actually buying it below the intrinsic value. That is the intrinsic value. Now, value investing is a very important concept. When we invest in a company, people just discuss prices. The prices do not tell anything about any stock. And that is why one has to go and read the balance sheet and the financials. The very famous saying that the accounting is the language of the business. So, like for understanding the human, you need to understand the soul. Similarly, to understand a business, one has to read the financials. Now, I teach financials in a course called Value Investing. So people understand how to analyze the balance sheet, how to understand what quality is there in the balance sheet. Because if people read financials well, very rarely they will lose money. And then I talk about the portfolio management because sometimes we go overboard, and there we exactly lose the money. So the portfolio management concepts and how one should construct the portfolio, how concentration beat the diversification, how diversification is against the ignorance, and why you should have a higher asset allocation. That's what I teach in a course called Value Investing. Now, the second course is about us. Now, many times when I invest and if I go wrong, which means there is something missing in me. And for that, one has to understand and observe their behavior. So there's a man called Daniel Kahneman. He's a doctor and he's a PhD, and he has his one of the student who later on also become a doctor called Amos Tversky, who's no more. They jointly worked on a lot of social science experiment, and they found that we all have a problem called selective attention. Now, in this podcast, when I talk about a lot of concept, everybody will have their different understanding because we are fed differently, and that's why we all are different on the outset. So, behavior finance is helping us to look inward to understand exactly who we are, what is suitable for me. For example, if somebody cannot handle the volatility of the stock market, like he can't see a stock going 50% down, stock market is not for him. And that's exactly what the behavior science tells us. So behavior finance is a subset of economics, and from there the behavior finance comes in. It talks about what kind of biases we have. People have overconfidence bias, they have anchoring bias. We all are somewhere the herd. We all have the issue of FOMO, and I'm sure you know the YOLO and all. So everybody has that problem. And if we understand us, if we through behavior finance, we can actually understand what kind of mistakes we commit while taking decisions. It is not only good for the investing, it's also good for life and business. These are the two master classes I take. So generally we call them to office or we conduct in a hotel. We charge a very paltry amount. The whole idea of that they get serious and sincere and they come on time and they participate. So we conduct in what you call the any premise where it is possible to conduct. I also go to colleges and teach, and in the future I would love to teach in the college, and I would like to make my second generation and third generation not to commit the mistake which we have committed, and that is how we conduct the masterclass. So I remember those days when we used to make 5-6% for investors and they were very happy. And then the time comes in, we made them 30%, 40%. And I think the last year we did roughly 25%. The challenge with investor mindset, or all of us as a worldly people, we keep becoming greedy and greedy. And also out of the 5 years, the 4 years have been positive. People think that every year will be positive, but that's not the case. So my request to investors is not to focus on monthly or quarterly return, not to focus on yearly returns, but focus on the process. Many a time I feel very painful when people say they invest because somebody else has invested. I think we all should learn to do our due diligence. We all should learn to understand the process. If the process is great, the outcome will come. Like a lot of people ask me about beating the indices. We have beaten the indices from the beginning. But this question should not arise, because if you follow the process of buying the great quality company from indices at a right valuation, in the long run, the indices have to be beaten. So my request and my message to all the investors is to please keep your expectation low, a 10 to 13% expectation. And I also would like to them to have a longer timing horizon, because equities can remain subdued for at least 2 to 5 years, and you can never find the reason. So one humble request is to have the expectation low for the return. The second expectation is to have a longer time horizon. My message to the equity investors who are starting their journey is, first, at least read 5 books. The second message for me is read balance sheets and financials. And if you can't, then please attend the courses run by the professional investors who have been investing their own money, or they have been promoting value investing. After doing that, understand that behind every company there is a business. If you are qualified to do it, you invest in the stock. If you think you do not have enough time to dedicate for it, you should invest through mutual funds or exchange traded funds or the hedge fund managers like us. Now, it's a very important thinking that it is not necessary that if you are a chartered accountant, you can be a great investor because you might not have the attitude to do so. So this is what my my message to all the beginning investors.